Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Tuesday, February 14th, 2023. It's great having you with me here today. We're going to talk about inflation. CPI, Consumer Price Index, came in at 0.5 on the overall reading and zero point 0.4. Yes, a movement back from the negative print we've seen, but gas and oil have gone up a little bit, so a little bit of give back there. But really a mixed number. Two things to really appreciate in this: that expectations are low in the marketplace. Now, that may not be in the consumer marketplace, but it's definitely in the investment marketplace. So it wasn't surprise when we saw this number come in line, the market reacted negatively to it. And we're also seeing the 10-year moving higher today because of that. What that's telling us is that expectations for this year in the market is for around 2%. And that's likely to disappoint because we're coming from such a high level and moving down. Not sure we're going to quite make that descent. And so as we get prints that are telling us a little bit higher, that's sort of a struggle in the marketplace. Further, there is some residue elements of inflation that are out there. And we saw it in apparel, we saw it in recreation, and we saw it in education. Now, there are 8 categories of CPI, and we're familiar probably with the larger ones like energy and housing and medical care and food. But the lower 4 of them have a tendency to be a little bit more correlated to the market. And they're a little more volatile also. So they kind of move around a little bit, but they were kind of pointing north at this point. And it's not surprising given that we've had a fair amount of fiscal stimulus out there. And it continues to tell you that the consumer is maybe a tad worried, but about today, not so much. And so the spending continues to be at an elevated level. And not surprising, we'll probably see that elevation continue as we move forward. So yes, housing is higher through the print. That's the BLS, Bureau of Labor Statistics look. We're not getting the same numbers in the real estate industry. We're seeing rents actually coming down. So we do expect that housing component, 40% of the index, to actually lead us down. In this number, we also saw negative medical. Medical is about 10%, so it's 1/4 of what we would expect out of housing. However, it is moving south, and the movement is related to insurance. Again, not something that's really sustainable, so we would expect that to kind of move up. Yes, housing at 4 times, medical probably help. One thing we do want to note is that when we look at it and the PCE, which is personal expenditure consumption number, remember that one drives itself from the GDP. And because of that, it has a little different mix to it, a little more medical, a little less. And that's the preferred one. Actually, the core is preferred. And so we'll probably see a little bit lower on the core as we move forward because of this number. So that's something to be aware of. But yes, the trends. And the other thing I should mention is about used cars. That actually went up. Manheim index is down. So we've got some cross currents going on here. Would expect the larger numbers like housing and the ones that have moved up dramatically like used cars to sort of wane as we move forward. And I think that's enough to keep the inflation concerns at ease. Not surprising, we're going to see a rough road because expectations about inflation are tied to what the Fed does, and then that ties to interest rates. Ahead, we should see the disinflation coming through, which I think is constructive for the market. However, the road to get there will be a little bit challenging. This is Scott Murray for the Daily Economic Market Shout. Thanks for joining me.